Welcome back to the Deep Dive. Today, we are tackling something really interesting. We're essentially doing a high-stakes translation job.
That's a good way to put it.
We've got a really complex financial analysis. It's the Q3 2025 earnings report for Quantum Computing Inc., or QUBT. And our mission today is to cut through all that jargon, bypass the big headlines, and really get to the core operational truth of the company.
That's exactly right. And with a deep R&D company like this, especially in a field as, cutting edge as quantum tech, the market tends to just jump on two numbers.
Revenue and profit.
Revenue and profit, or lack of profit. But the thing is, those two numbers are often the least reliable indicators of the company's actual long-term health.
Absolutely. So if you're someone who really wants to understand how a high-growth company works, especially one that's intentionally burning cash to build a future, then this deep dive is for you. We're going to show you how to read this report. The goal here is to really separate that GAAP accounting profit, the number they have to report, from the actual core operational performance.
The performance of the quantum business itself.
Exactly.
And we've structured our analysis around the framework that was in the source material, which breaks it all down into 5 key slides. So we're just going to follow that roadmap step by step.
And we'll announce each section as we go.
Yeah, and by the end, you won't just know what QUBT reported, you'll understand the whole financial strategy that's really underwriting this entire race for quantum supremacy.
Okay, let's do it. Let's unpack this and start with, the flashiest part of the report. All right, so we begin with slide 1, the at-a-glance scorecard. This is where the company, broadcasts its big headline numbers. And QUBT delivered a massive beat.
A huge beat on both the top and the bottom lines for Q3 2025. And the initial market reaction was, electric?
Let's talk about the scale of this beat, because that's really what got everyone's attention.
It really is. So let's start with revenue, the top line. Wall Street consensus, what the analysts were expecting, was for a quarterly revenue of about $125,000.
Which is tiny.
Very small, yes. But QCI came in and reported actual revenue of $384,000.
Wow. Okay, so that's more than 3 times what analysts were expecting.
It's a 207.2% beat. Now, you're right. In absolute dollars, $384,000 is still, almost nothing for a public company.
Right.
But that percentage beat is what's so crucial here. It suggests that whatever commercial traction they're getting, it's happening way faster than the cautious analyst community had priced in.
So it's a signal of acceleration.
A major surprising acceleration in their go-to-market strategy, even if the total volume is still really low.
And then there's the bottom line, earnings per share. That was maybe even more of a shock.
Oh, absolutely. The consensus on the street was for a loss of 6 cents per share, so negative 6 cents.
Right, which for a company like this is totally normal.
Expected. But instead, they reported a diluted EPS of a positive 1 cent. They didn't just, lose less than expected. They actually flipped it completely to a surprise profit.
That's a huge swing.
It's a 7-cent swing per share from an expected loss to a small profit. And that is exactly the kind of thing that makes the stock market react dramatically.
And it did.
Oh, yeah. The immediate market response saw the stock trade up 9.46% to $11.60 in after-hours trading. That spike just confirmed the market's gut reaction. Profit good, beat great.
And then you saw the analysts just pile on right after. The initial comments were all super positive, right?
Mm-hmm. Things like notable revenue surge and positive EPS surprise, they all highlighted that accelerating commercial traction. So on the surface, it just looks like QCI is sprinting ahead.
And the internal numbers, the year-over-year data, that looks even crazier.
It's explosive. Total revenue growth compared to Q3 of 2024, when they did just $101,000, was up a staggering 280%.
And the net income?
That went from a loss of $5.7 million in the same quarter last year to a $2.4 million profit this quarter.
Okay, so before we get into let's call it the magic trick that created that profit.
It's a good word for it.
We have to touch on a key technical point that I think trips a lot of people up. And that's the difference between basic and diluted EPS.
Yes, this is fundamental. You have to understand this. Basic EPS is the simplest way to look at it. You just take the net income and divide it by the number of common shares that exist right now.
That's your basic profit per share.
Simple as that.
Diluted EPS, though, that's the one that's always more conservative. It's the worst-case scenario measure, right?
Correct. So diluted EPS takes that same net income, but it divides it by a hypothetical maximum number of shares.
Okay.
It basically assumes that every single thing out there that could become a common share stock, options, warrants, convertible bonds, you name it, it assumes they have all been exercised.
So it shows you how thin the profit would be spread in that fully diluted scenario.
Exactly. And so for a company like QCI, which uses shares and warrants all the time for financing and for paying employees, the diluted EPS is always the more, let's say, thorough and honest measure.
And in this report, both basic and diluted were reported as 1 cent.
They were, but the mechanism underneath is really important. The number of weighted average diluted shares they used for the calculation was 166.8 million.
And last year.
Last year, it was 93 million.
Wow, that's a huge increase.
It's almost double in 1 year. And that tells you that QCI has been aggressively using its equity, its stock, to fuel its growth. So even though they reported a profit, that potential for future dilution is a constant risk you have to watch.
That is essential context. Okay, now let's get to it. The real aha moment of this section. Let's deconstruct this headline beat. How on earth did they generate a profit when they are clearly pouring money into R&D?
This is where we separate the headline skimmer from the informed analyst. If you look at the core engine of the company, the actual operational health of the quantum computing business, it is losing money.
And not just losing money.
Losing money at an accelerating rate. The source material is clear. The loss from operations actually got worse. It grew from a $5.4 million loss in Q3 of 24 to a $10.4 million loss this quarter.
Wait, hold on a second. So the core business lost over $10 million this quarter, but the company reported a net profit of $2.4 million. That's a $12.8 million gap. That has to be coming from somewhere completely non-operational.
Precisely. The $2.4 million in net income came entirely from two large non-operational line items. The core business lost $10 million, but these two gains came in, wiped out that massive loss, and still left enough to create a paper profit.
So what are the two items?
Okay, first, the smaller one, but it's still substantial. $3.5 million in interest and other income.
So this is just interest on their cash.
That's all it is. QCI is acting like a very well-funded bank. They have a massive pile of cash, and they put it in high-yield instruments, and they earned $3.5 million on it. That's treasury management, not quantum tech sales.
A good sign they have cash, for sure. But it doesn't mean the Dirac 3 machine is flying off the shelves.
Not at all. But the second item is the big one. This is the real driver of the profit. A $9.2 million non-cash gain from the change in fair value of derivative liability.
Okay, you have to explain that one. That sounds like pure accounting jargon.
It is, but it's crucial. Think of a derivative liability as a kind of a potential obligation the company has. For a startup like QUBT, this almost always relates to warrants that they issued during past financing rounds.
So warrants give investors the right to buy stock at a fixed price later on.
Exactly.
Right.
A right, not an obligation. Now, under some very complex accounting rules, these warrants have to be revalued every single quarter based on things like the company's stock price and its volatility.
And if the value of a liability in your books goes down, that's a gain for you.
That's the trick. Imagine QCI issued these warrants when their stock price was higher. If the stock price then falls, the theoretical value of that liability, what it might cost them in the future, decreases.
And that decrease is recorded as a gain.
A non-cash gain on the income statement. That $9.2 million is purely an accounting entry. No cash changed hands. No quantum machine was sold. It's just a number on a spreadsheet changing.
That's astonishing. That $9.2 million paper gain is 24 times larger than their entire quarterly revenue.
It utterly dominates the financial picture. It's the whole story.
So if we put this all together,
the conclusion is undeniable. The 1 cent EPS profit was entirely a function of, 1, managing their cash pile, and 2, this complex accounting adjustment. Those two things added up to almost $12.7 million, which completely wiped out the $10.4 million operational loss.
So the big headline beat was basically a byproduct of their financing structure. It was masking the fact that the actual R&D business is successfully burning cash at a faster rate.
Which is exactly what a high-growth company in this phase should be doing.
Right.
The takeaway here is that QCI did not achieve operational profitability. They achieved an accounting profit while successfully accelerating their strategic loss. And that context changes how we have to read everything else.
That sets the stage perfectly. So let's move inside the operational structure and see exactly where that $10 million is going. Okay, we're moving to slide 2, which we've titled The Engine of Profitability. And even though we know the bottom line was, let's say, skewed by those paper gains, we still have to look at the health of their actual commercial efforts and their strategic spending.
Let's start with gross profit and margin. So gross profit is just what's left after you subtract the direct costs of generating a revenue.
Materials, labor for specific contracts, that kind of thing.
Exactly. Numerically, gross profit went up to $126,000 this quarter, which is a big jump from just $9,000 in the same quarter last year.
And that pushed the gross margin percentage way up from 9% last year to 33% this quarter. I mean, quadrupling your margin percentage sounds like a huge step towards being more efficient.
It does, and it is a positive indicator, but we have to immediately listen to what management said about it.
What was their warning?
They explicitly stated that the margin variation is not significant because the revenue levels are still so low. And that is a critical piece of insight when you're looking at small companies.
Right. Why is that unpredictability at low scale so important to keep in mind?
Because with revenue of only $384,000, the mix of just 2 or 3 contracts can swing your margins wildly. Maybe one contract is all high-margin software consulting, and the next one involves building some custom hardware prototype at almost 0 margin. The mix of those two could swing your overall margin from, say, 5% to 50% in a single quarter.
So we can't really trust that 33% number as being stable.
Not at all. We won't see predictable margins until revenue gets up into the tens or hundreds of millions. Until then, you just have to view it with a healthy dose of skepticism.
Okay, that clarifies the commercial side. So now let's get back to the main story here. That operational loss, we already know it widened to $10.4 million.
Which confirms the engine of the business is just running full throttle, burning cash.
And that's by design.
Completely by strategic design. Total operating expenses shot up 93.3% to $10.5 million. And when you see a deep tech company accelerating its burn rate like this, there are only 2 questions that really matter.
Is the money being spent well, and can they afford it?
That's it. So let's break down where that $10.5 million in spending is going.
Where is the aggressive investment concentrated?
It's overwhelmingly focused on building their technology moat. Research and development, R&D, increased aggressively. It nearly doubled, up 100.9% to hit $4.5 million this quarter.
100% year-over-year increase in R&D. I mean, that's a loud and clear signal.
It's unmistakable. They are moving into an accelerated development phase, throwing major resources at technical breakthroughs. In a race like quantum computing, you have to spend exponentially just to stay ahead.
And that $4.5 million, that's likely going to, highly specialized engineers?
Oh, yeah. PhDs, specialized engineering talent, procuring exotic materials, and actually building out the capabilities of their first physical production facility, their Fab 1. This isn't just theory on a whiteboard anymore. This is capital being turned into physical and intellectual property.
And what about the second big bucket of spending? General and administrative, G&A. That also grew a lot.
It did. G&A was up 84.3% to $5.2 million.
Which is actually more than R&D.
It is, which is pretty common for a company that's scaling this fast. G&A covers the expansion of the operational backbone.
So hiring CFOs, lawyers.
Exactly. General counsel, sales teams, marketing teams, building out robust IT and compliance systems. You can't double your R&D budget if you don't also double the support structure holding it all up. This spending is what prepares the company for commercial scale whenever that day comes.
So when management says this is all about continued investment in research and development, engineering, and manufacturing to position the company for long-term growth,
the numbers back it up perfectly. That $10.4 million loss isn't a failure. It's actually proof that they're executing on their stated strategy.
And that brings us back to that critical point from slide 1.
The synthesis, yeah.
Yeah.
The difference between GAAP profitability and operational reality. Look, if QCI had reported a shrinking operational loss this quarter, I would actually see that as a red flag.
Because it would mean they're pulling back on investment.
It would suggest they were hitting the brakes on R&D, maybe because of money troubles or fear. Instead, they successfully managed to increase their operational burn by 93%. They are hitting the gas pedal hard.
So the GAAP net income of $2.4 million is just a financial curiosity.
A curiosity caused by non-cash adjustments. The operational loss of $10.4 million, that is the truthful metric of their strategic aggression. For QCI, right now, success is measured by how effectively they can turn cash into R&D output, not by making a small profit from their treasury department.
Which brings us to the next and probably most important question of all. If they're burning $10 million a quarter, how long can they possibly keep this up? Okay, so we are skipping slide 3, as it wasn't provided, and we're jumping straight into the heart of the matter. This is slide 4, financial strength. And this section really explains how QCI can afford to strategically lose $10 million a quarter. The whole story here is liquidity. It's their war chest.
This is, without a doubt, the most strategically significant part of the entire report. For a company like this with such a long R&D timeline, financial strength is everything.
It's paramount.
So let's look at their liquidity before we even get to the big financing news they dropped in the commentary.
Right. As of the end of Q3 2025, they were already sitting on a huge pile of cash.
Incredibly liquid. They had $352.4 million in cash and another $460.6 million in total investments, which are, usually very liquid things like short-term treasury bills.
So that's a combined total liquidity of, what, run at $813 million?
Roughly, yeah.
$813 million in liquid assets against a $10 million quarterly burn rate. So even before any new financing, they had enough cash to fund their current operations for about 20 quarters.
For 5 years.
5 years, that's already a fantastic position to be in.
It gives them immense stability, and their balance sheet health is just pristine. Total liabilities were minimal, just $20.3 million, and total shareholders' equity stood at $877.9 million.
Let's use those numbers to quickly calculate their debt-to-equity ratio, because that's a classic metric that tells you how much a company relies on borrowed money.
Right. It's a simple calculation. You take their total liabilities, the $20.3 million, and you divide it by their total shareholders' equity, the $877.9 million.
And you get a ratio of
0.023, or just 2.3%.
I mean, that is effectively zero debt for a company this size.
It's an extraordinarily low ratio. It just screams solvency. They're financing this entire high-risk, high-reward push almost exclusively through equity capital and their own cash reserves.
Which gives them huge flexibility.
Vital flexibility. They're not beholden to any debt covenants, and they still have the maximum capacity to go out and borrow later if they, say, need to accelerate manufacturing in a big way. They're in complete control of their financial destiny.
Okay, so now we have to get to the event that completely dwarfs this already impressive balance sheet. We're talking about the $1.5 billion strategic transformation that was revealed in the management commentary.
This changes everything.
I was genuinely shocked by the scale of this.
It's a game changer. So management revealed that subsequent to the quarter end, so after the books closed on this report, QCI raised an additional $750 million.
So you have to add that to the $813 million they already had.
You do, which means their combined liquid position, their total war chest, is now over $1.5 billion.
That is a staggering amount of capital for a pre-profit company whose revenue is still below $500,000 a quarter.
Just think about the strategic impact of that. It is a declaration of intent. It completely de-risks the company for years to come. Management called it securing a multi-year runway. And they're not exaggerating.
So they've bought themselves time.
They've bought time, patience, and the ability to execute without having to worry about market downturns or having to do frequent dilutive stock offerings.
And with $1.5 billion, they can start thinking on a totally different scale. They're not worried about making payroll next year. They are planning for, well, for global dominance.
And that capital is going straight into the big capital-intensive plans we talked about earlier. It lets them not just sustain that R&D burn, but potentially accelerate it even further. But more importantly, it funds the physical build-out.
Fab 1.
The thoughtful scaling of our foundry. Fab 1, that's where they'll make their specialized components.
But the real game changer is what comes after that.
Precisely. The runway is so long now that they're already putting significant resources into planning for Fab 2, a second, larger facility.
Building a second, larger manufacturing plant that is a multi-$100 million project.
Oh, yeah. And to be planning for it now, fully funded, confirms their transition. They are moving from being a research lab to becoming a major industrial player.
This feels like a huge strategic chess move in the quantum race. It signals that their biggest constraint is no longer money.
The financing risk is gone.
The constraint now is just technical execution and the time it takes to build these things.
It's just the entire investor narrative. Before this quarter, the biggest risk was funding the long R&D cycle. Now that risk is almost gone. The risk now is, can they effectively spend $1.5 billion?
Can they hire the right people, build Fab 1, break ground on Fab 2, and stay ahead of the competition?
Exactly. This quarter was a strategic financing victory that underwrites their next 5 years of operations.
This really confirms why we have to look past that EPS headline. The EPS was a footnote.
The $1.5 billion raise is the novel.
So that brings us to our final stop, slide 5, the road ahead. Now that we understand QCI has this massive financial foundation, let's look at their forward-looking narrative and search for those early signs of commercial success.
Yeah, management's focus is clearly on flawless long-term execution now that it's backed by this incredible $1.5 billion buffer. Their communication is all about reassuring investors that the money is going to be spent methodically.
They talked about their strategy focus, right?
Yeah.
Emphasizing their integrated photonic approach.
They said, our integrated photonic approach continues to differentiate QCI. Photonic quantum computing using light and optical circuits, that is their core technological bet.
They're doubling down.
With $1.5 billion, they can afford to double down on this single high-conviction approach until it matures, believing it will win the race over other methods like superconducting circuits.
And their execution focus seems to perfectly mirror the spending we just saw on slide 2.
It does. Management said, we remain focused on technical execution, strategic hiring, and thoughtful scaling.
The same 3 pillars.
The same 3 pillars. Spend on R&D, use G&A to hire top talent, and convert the cash into physical infrastructure like Fab 1 and planning for Fab 2. They're following the deep R&D blueprint to a T.
We also have to zoom in on that commercial validation piece.
Yeah.
The revenue is tiny, yes, but management pointed to expanding commercial traction.
And in this early phase of quantum tech, the validation from a big-name, mission-critical customer is honestly far more important than the dollar value of the contract itself.
They're seeking credibility, not cash flow.
That's the key metric for a new technology. And they gave 2 fantastic examples. First, a recent sale to a top 5 U.S. bank.
I mean, that is a colossal stamp of approval. What does selling to a top 5 U.S. bank really imply?
It implies they successfully navigated a massive regulatory and security minefield.
Right.
The biggest financial institutions have incredibly complex compliance, data security, and procurement processes. For QCI's tech to get vetted and bought by a company like that suggests a level of maturity and reliability that goes way beyond a typical startup. It validates their tech as enterprise grade.
And the second example was a project with NASA.
Yeah, advancing a project where they're applying their Dirac-3 quantum optimization machine to complex LiDAR data.
So this is a high-level technical validation.
Exactly. NASA is trying to solve these computationally impossible problems with mapping and data processing. Using the Dirac-3 for LiDAR suggests the machine is actually effective at solving complex real-world optimization problems, which is a key selling point.
So you have these 2 huge wins.
Yep.
One in finance for security and one in science for complexity.
It provides powerful, diverse validation that the technology is actually useful, not just a lab experiment.
And these early wins are the foundation for the $100 million contracts of the future. They're building trust.
That's exactly it. They're showing they can turn R&D into demonstrable customer results, which is the necessary bridge to full commercialization.
Okay, let's try to integrate everything we've talked about into 3 key takeaways for our listeners.
Let's do it. Takeaway 1, accounting versus operations. We have to be crystal clear on this. That positive 1-cent EPS was a sophisticated accounting event. It was driven by that $9.2 million derivative gain.
Not by selling quantum computers.
Not at all. The true operational story is the successful strategic acceleration of their loss to $10.4 million. That proves aggressive R&D execution.
Okay, takeaway 2. The balance sheet is the story. The real achievement this quarter was financial security.
Absolutely. But securing over $1.5 billion in liquidity, QCI has profoundly de-risked its future. This cash funds the scaling of Fab 1 and the critical planning for Fab 2. This is the quarter they bought their future.
And number 3.
Takeaway 3. Nascent validation is the measure. Revenue is still small, but the high percentage growth confirms things are moving faster. And more importantly, the quality of that validation selling to a top bank, partnering with NASA, provides the critical evidence that the tech is moving from theory to utility. And that's the most valuable asset in the quantum race right now.
So our final narrative synthesis is clear. This quarter was not about profitability. It was a massive financial strategy success. They secured the war chest they need to turn their theoretical advantage into physical and commercial reality.
And that's why we spent all this time deconstructing a report whose headline you could read in 30 seconds. By using this kind of framework separating cash flow, non-cash gains, strategic financing, you go from just reading numbers to understanding the profound strategic decisions a company is making.
So for you, our listener, we really encourage you to apply this framework to other high-growth, pre-profit companies. When you see a big stock jump or an unexpected beat, your first instinct should be to hunt for those non-operational income lines.
Did the profit come from selling assets? treasury management,
Yeah.
or an accounting adjustment. That distinction is the difference between real insight and just speculation.
Which leads us to a crucial final thought here. QCI has just cleared the biggest hurdle in deep tech, securing the capital. They have $1.5 billion. The focus now shifts entirely from Wall Street to, Silicon Valley and the manufacturing floor.
Right. So the really provocative question for the next, say, 6 quarters is this. How quickly and effectively can they convert that massive pile of capital into tangible assets and technical milestones? Can they announce the groundbreaking for Fab 2? Can they hit their R&D benchmarks before market patience, even with this long runway starts to wear thin? The pressure now is solely on flawless, high-speed delivery.
And as always, we must provide our necessary disclosures. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional.
We should also note that this report was generated by an artificial intelligence model, integrating company data with publicly available market data. All information, including financial data and calculations, should be independently verified by the user.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.